Hello and welcome back to the channel. Today we're diving deep into the world of growth investing, and more specifically, the exchange-traded funds, or ETFs, that every investor should be watching in 2025. Growth stocks have once again become the center of market excitement, thanks to major developments in artificial intelligence, semiconductors, cloud computing, and disruptive innovation. For investors who want exposure to the fastest-growing sectors of the economy without having to pick individual winners, growth ETFs can be an excellent way to go. In this video, we're going to focus on 4 standout growth ETFs that have the potential to shape portfolios in 2025. These are the FFTY Innovator IBD50 ETF, the IGV iShares Expanded Tech Software ETF, the SMH VanEck Semiconductor ETF, and the ARKK Innovation ETF from ARK Invest. Each of these funds offers a different flavor of growth exposure, and by the end of this video, you'll have a full picture of what they are, how they work, and which ones might fit your personal strategy. Before we begin, just a quick reminder, this video is for educational purposes only and not financial advice. Always do your own research and consider your risk tolerance before making investment decisions. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. So, let's get started by quickly understanding what growth ETFs really are. Growth ETFs are funds that focus on companies expected to grow their earnings, revenues, or cash flow at an above-average rate compared to the overall market. Unlike value ETFs, which target companies that are considered undervalued relative to their fundamentals, growth ETFs look for momentum, innovation, and expanding industries. They're typically more volatile than broad market funds like the S&P 500, but in bull markets, they tend to outperform significantly. The trade-off is that in downturns, they can fall harder and faster. Now, why is 2025 such a unique year for growth ETFs? The simple answer is that the economic drivers of growth are evolving faster than ever before. Artificial intelligence is no longer a concept, it's being implemented across industries, from finance to healthcare to manufacturing. Semiconductors are the backbone of that transformation, powering AI models, cloud computing, and advanced robotics. Software remains the engine of digital transformation, with SaaS companies delivering recurring revenue streams. And on top of all that, there's the rise of disruptive innovation in fields like biotechnology, electric vehicles, and blockchain. Growth ETFs are sitting right at the heart of these megatrends. Let's dive into the first ETF on our list, FFTY, the Innovator IBD50 ETF. FFTY is a unique fund because it doesn't just passively track an index like the S&P 500. Instead, it's based on Investors Business Daily's IBD50 growth stock list, which is updated regularly. The methodology is designed to highlight the 50 leading growth companies at any given time, based on earnings, sales growth, and stock price momentum. That means FFTY is constantly rotating into companies that are performing well in the moment, whether they're in technology, healthcare, consumer discretionary, or even industrials. This active, rules-based approach gives FFTY a very different feel compared to traditional growth ETFs. The upside is that when growth is strong, FFTY can capture big momentum-driven runs, because it's always targeting market leaders. The downside, of course, is that it has higher turnover and can be more volatile. It also tends to carry a higher expense ratio compared to broad market growth ETFs. So why watch FFTY in 2025? Simply put, the stock market is being driven by powerful innovation themes, and FFTY's dynamic rebalancing means it's likely to keep exposure to whichever companies are leading at any given time. If we continue to see AI, cloud, and software companies rally, FFTY is designed to catch those winners quickly. For investors who like momentum investing but want to do it through an ETF, FFTY is a compelling option. Now let's move on to the second ETF, IGV, the iShares Expanded Tech Software ETF. IGV is one of the most popular software-focused ETFs on the market. It gives investors concentrated exposure to large and mid-sized software companies, including giants like Microsoft, Adobe, Salesforce, Intuit, and ServiceNow. These are companies that have become essential to the modern economy. They produce subscription-based services, cloud platforms, cybersecurity solutions, and enterprise software that businesses rely on every day. What makes IGV powerful is the stability of its growth. Software companies tend to have recurring revenues, high profit margins, and sticky customer relationships. Even in economic slowdowns, many businesses can't just cancel their software subscriptions, which makes IGV more resilient than some other growth ETFs. In 2025, IGV looks particularly attractive because of the acceleration of artificial intelligence integration into software products. Microsoft is embedding AI into Office, Adobe is enhancing its Creative Suite with AI tools, and Salesforce is rolling out AI-powered CRM features. These innovations make software more valuable to businesses, which increases revenue potential for these companies. Of course, there are risks with IGV. The valuations of software companies are often high, meaning that if growth slows down, stock prices could drop sharply. But as a long-term play, software remains one of the strongest sectors in the growth universe. For investors who want more stability within growth, IGV is one of the best options. Now let's shift to the third ETF, SMH, the VanEck Semiconductor ETF. If you believe in the future of artificial intelligence, cloud computing, electric vehicles, or even advanced manufacturing, then you know semiconductors are at the core of it all. SMH is one of the most popular semiconductor ETFs, giving investors exposure to companies like NVIDIA, Taiwan Semiconductor, Broadcom, AMD, and ASML. These companies design and manufacture the chips that power everything from smartphones to supercomputers. The semiconductor industry is cyclical, which means it goes through boom and bust cycles depending on supply and demand. But the long-term demand story is incredibly strong. With AI models requiring massive computing power, data centers expanding globally, and new technologies like autonomous vehicles on the horizon, semiconductors are more essential than ever. In 2025, SMH looks like one of the most direct ways to play the AI revolution. NVIDIA, in particular, has become the poster child for AI chips, and its dominance in GPU technology gives it a strong advantage. At the same time, companies like TSMC and ASML are critical to the global chip supply chain, making SMH not just a US play but a global one. The risks with SMH are clear. It's heavily concentrated in just a few companies, and if the chip cycle turns downward, returns can be hit hard. But for investors with a strong belief in long-term innovation trends, SMH offers one of the most powerful growth opportunities available. Finally, let's talk about ARKK, the ARK Innovation ETF managed by Cathie Wood and her team at ARK Invest. ARK is perhaps the most famous growth ETF in the world, known for its aggressive bets on disruptive innovation. Its holdings include companies like Tesla, Roku, CRISPR, Coinbase, and UiPath. What makes ARKK unique is that it's not just about current leaders, it's about the companies that ARK believes will transform industries in the next decade. That includes artificial intelligence, DNA sequencing, robotics, fintech, and blockchain technologies. ARK is a high-risk, high-reward ETF. Its performance history reflects that. Massive gains during the 2020 tech boom, followed by steep losses when interest rates rose and speculative stocks sold off. For many investors, ARKK represents the most volatile part of the growth ETF universe. So why watch ARKK in 2025? Because if markets shift back toward rewarding innovation, ARKK could deliver outsized returns. The themes it invests in are undeniably powerful, but timing is everything. Investors who can stomach the volatility may find ARKK an exciting way to participate in cutting-edge technologies. Now that we've gone through each ETF individually, let's take a moment to compare them side by side. FFTY gives you momentum-driven growth leaders across sectors. IGV provides steady exposure to software companies with durable revenue models. SMH gives you direct access to the semiconductor industry, which is powering the AI revolution. And ARKK offers a high-risk, high-reward bet on disruptive innovation. In terms of risk, IGV is the most stable, SMH and FFTY sit in the medium to high range, and ARKK is clearly the most volatile. Expense ratios also vary, with IGV and SMH offering lower cost exposure compared to FFTY and ARKK. Ultimately, the right choice comes down to your personal strategy. If you want conservative growth, IGV is a solid pick. If you're betting on the future of AI and chips, SMH is compelling. If you prefer chasing current leaders, FFTY could work for you. And if you're willing to take on big risks for potential outsized rewards, ARKK is the place to look. So, what's the bottom line? Growth ETFs in 2025 are positioned to benefit from some of the biggest technological transformations in history. Whether it's the rise of AI, the dominance of software, the necessity of semiconductors, or the disruptive power of innovation, these funds provide a way for investors to get exposure without having to pick individual winners. Thank you so much for watching today's deep dive on the top growth ETFs to watch in 2025. If you enjoyed this breakdown, don't forget to like the video, subscribe to the channel, and hit that notification bell so you don't miss future content on ETFs, investing strategies, and long-term wealth building. And now I want to hear from you. Out of FFTY, IGV, SMH, and ARKK, which one do you think has the best chance of outperforming in 2025? Drop your thoughts in the comments below. I'd love to hear your perspective. Until next time, I'm wishing you smart investing and steady growth. See you in the next video.